So, what if I told you there's a mathematical language that can take the messy, complicated job of managing a huge investment portfolio and make it, well, incredibly simple and powerful? Today, we're going to unlock that language, linear algebra. Let's dive in and see how it works.
Just imagine this for a second. You're managing a portfolio, not with 3 stocks, but with 500. And you have to figure out its total performance every single day. How in the world do you do that without getting completely buried in a mountain of spreadsheets and calculations? And this isn't just some hypothetical question, right? This is a scaling problem that every serious investor faces sooner or later.
I mean, trying to do this manually, one by one, it's a total nightmare. It's slow, it's so easy to make a mistake, and it's just plain messy. But what if we look at the problem a different way? If we use the language of linear algebra, that nightmare transforms into something clean, fast, and honestly, it's kind of beautiful.
Okay, let me show you exactly what I mean. On the left, that's the manual way, a long, clunky line of code for just 3 assets. Now look at the right. That's the linear algebra way, one single, clean command. And here's the kicker. That one line can handle 3 assets or 3,000 assets, and it doesn't even break a sweat. This right here, this is the magic we're going to unpack.
All right, first up, let's dig into what we actually mean by the portfolio scaling problem. It's really a story of doing things the hard way versus doing things the smart way.
So this is what the hard way looks like. Without the right tools, you're stuck here. You've got the SPY return and its weight, the QQQ return and its weight, and so on. You have to multiply each pair together, then add all of those up. You know, for 3 funds, okay, maybe you can manage it. But what about 30 or 300? No way. The whole process just completely breaks down. And that brings us to the elegant solution. Instead of seeing all our data as just a jumble of loose numbers, we're going to give it a serious upgrade. We're going to organize it using the core tools of linear algebra. The first building block we need to understand is the vector. Now, simply put, yeah, it's just an ordered list of numbers. But a much better way to think about it is as a container, a neat little package that holds a whole set of related data together. It's kind of like your portfolio's DNA, all bundled up in one compact object. And here's what that transformation looks like in practice. See that? All those individual numbers from before are now neatly packaged into 2 separate vectors. We've got a weights vector and a returns vector. Now the data is structured, it's clean, and it's ready for us to do some really powerful math with it. So if a vector is a single list, what's the next level up? Well, that would be the matrix. If a vector is a list, you can think of a matrix as a grid or a spreadsheet. It's got rows and columns. This lets us organize data across 2 dimensions, like assets and time. It's like a financial time-lapse, capturing everything in one structure.
So take a look at this. This matrix perfectly captures the prices of our 3 assets over a 5-day period. Each row is a different asset, SPY, QQQ, IWM. And each column? That's a different day. All that crucial information is sitting right there in one clean, structured object, ready to go.
All right, so our data is perfectly organized into these neat vectors. So now what? Now we introduce the operation that unlocks all of this power. It's called the dot product. And this one little operation is basically your P&L engine. So what the heck is a dot product? Don't let the name scare you. It's actually super simple. It's a 2-step process. First, you multiply the matching items from 2 vectors. Then you just add up all those results. That's it. It's the mathematical engine for calculating any kind of weighted total. Let's just walk through one right now. First, we line up our weights and returns vectors. Then we multiply the corresponding pairs. First weight times first return, second times second, third times third. That gives us 3 separate little products. And the final step, we just sum them all up. And there it is, 5.3%. That single number is the total weighted return of your entire portfolio for the day. This is that aha moment, right? That messy, manual calculation from the beginning has been replaced by this one clean, super scalable operation. And I am not exaggerating when I say this. The dot product is the fundamental operation in modern portfolio management. For real, everything else we're about to do is built on top of this one core idea.
Okay, calculating one day's return is great, but what about a week, a month, a whole year? How do we use this to look back in time and test a strategy, a process we call backtesting? Well, you guessed it. That's where our friend the matrix comes back into play.
This is really the next level of the scaling problem. We don't just care about today's return, we need to analyze performance over hundreds of trading days all at once. To do that, we need to take our dot product operation and scale it up from 1D vectors to 2D matrices.
And here's how it works. We take our single weights vector and we multiply it by a whole matrix of historical returns, where each column is a different day. And the really cool part is that this single operation is basically doing 5 different dot products all at the same time, one for each day.
The result of that operation is a brand new vector. And each element in this new vector is the portfolio's total return for that specific day. Day 1, up 0.8%. Day 2, down a little bit. In one command, we've calculated the performance for the entire period, letting us see the daily ups and downs of our strategy.
And from there, it's easy. We can just compound these daily returns to get our total performance over the whole 5-day period. In this case, a gain of just under 2%. This right here is the core logic that powers pretty much every modern backtesting engine out there.
Wow, okay, we have covered a lot of ground. We've gone from simple vectors all the way to powerful matrix operations. So let's wrap this up by summarizing the most critical, most actionable takeaways you need to know. All right, here's your cheat sheet. Remember, we used vectors to organize our data into neat containers. We use the dot product as the engine to instantly calculate our portfolio's return. To analyze performance over time, we level up to matrices, and matrix multiplication is our secret weapon for running those backtests efficiently. And 2 final tips. Always make sure your weights add up to 1, and if you're coding this, use a library like NumPy. It's built for this stuff, and it is lightning fast.
And so we end up right back where we began, with this single line of code. But now you get it. You understand it's not just a command, it's the elegant result of organizing financial data into vectors and applying the dot product. This is the engine of modern finance.
At the end of the day, this isn't just about code. It's a totally new way of thinking about financial data. It's the language of scale, efficiency, and real power. So the question I'll leave you with is this. Now that you have this powerful tool in your hands, what will you build with it?